Each week in this segment of the Washington Journal, we take a look at how your money is at work in a different federal program. And this week we're focusing on a program that's $25 billion in debt. We're joined by Stephen Ellis of Taxpayers for Common Sense to help understand why and efforts to reform that program. It's the National Flood Insurance Program. Steve Ellis, remind us what the program is, who administers it, and who it's for.
Sure. So in 1968, Congress determined that there wasn't enough availability of affordable private flood insurance, that there was a perceived market failure. And so they created this program where actually the federal taxpayer would be providing this insurance to people. And then also that if you lived in a high-risk area, if you lived in what they dubbed the 100-year floodplain, so it's about a 1% chance any given year that you would flood, that if you had a federally backed mortgage, you were required to purchase flood insurance. And so over time, there's about 5.1 million policies in the federal flood insurance program. This is it brings in about $3 billion in premium, but as you noted, it's $24.6 billion in the hole, and so it's quite a bit in debt and has significant problems and is being underwritten by the taxpayer.
This program currently up for reauthorization. What does that mean?
Well, so Congress is basically, a lot of times with federal programs, is that they authorize them to go for a certain period of time, and then they look at them again and reauthorize them, maybe change them. This is true of farm programs, this is true of transportation or aviation, and it's true of the federal flood insurance program. And so it had a 5-year reauthorization in 2012. So here we are in 2017, and it expires September 30th.
Does it have to clear that debt before it can be reauthorized, or can it carry that over?
It will carry that debt over. I mean, Congress would have to specifically forgive that debt, and actually they cap the amount that they can borrow. And so currently the cap is right about $30 billion. So they're not quite bumping up against it, but they're not that far away.
Who does Congress, or who does the government owe that debt to, the $25 billion? Who are we paying back?
Ourselves. So simply similar, if you look at even much more complicated, bigger program, but Social Security, we borrow from the Social Security program and then we pay that debt back with interest to offset other costs within government. It's the same sort of thing here, is that essentially the program has borrowed this money from taxpayers, from the Treasury, and is paying that back with interest.
As we're talking about this program, should note special lines in this segment. If you're in the Eastern or Central time zones, it's 202-748-8000 if you want to call in with your questions or comments. If you're in the Mountain or Pacific time zones, 202-748-8001 is the number for you. We're talking with Steve Ellis of Taxpayers for Common Sense. Has talked about this before, but you've also been a part of the process trying to reform the flood insurance program. What is the group you're working with it on the reform side?
Sure. So we've worked on this issue basically our whole 21 years of existence, but in the last maybe 10 almost years, we worked in a broad coalition called Smarter, Safer, and essentially this is a coalition of not just budget watchdogs like Taxpayers for Common Sense, but also conservation, environmental groups, consumer groups, housing interests, and insurance interests, because that's the other thing that has dramatically changed since 1968. There isn't a perceived market failure. Flood insurance is written by the private sector around the world, and so essentially the private sector wants to get more involved into this process, but is being priced out in some cases because of federal subsidies.
So why not pull the federal government out of this process and just turn it over to the private sector?
Well, I think that we're hoping that we're going to move in that direction, but I don't think you can just rip the Band-Aid off. I don't think that would be a responsible way to go about it. But I think that as you allow the flood insurance rates to become less subsidized and to move into the market, you're going to find more and more companies writing flood insurance, and we'll just sort of trend that way. And so, for instance, in the state of Florida, even today, there's 19 companies that are writing first dollar flood insurance. And they're writing flood insurance in all of the risk zones. So not just, one of the concerns people have had is that there would be so-called cherry picking. We're not as concerned about that because, one, you already only have the most risky policies or the most risky properties already in the flood insurance program. The only people buying it are the people who are the most likely to use it. But then also what we've seen is that there's an appetite for risk in all the risk zones. And so that the private flood market would actually be writing in coastal areas and high-risk areas as well.
You talked about 5 million policies written within the National Flood Insurance Program. Here's a map from USA Today showing the states that dominate where those policies are written. Florida with 1.8 million of those policies. Texas 605, close to 606,000. 200,000 in South Carolina, and so on around the map if you want to take a look. The $25 billion that this program is in debt, is that but for a few big storms, the program would be pretty much afloat? Was it Katrina and Sandy that caused this debt?
That was certainly, they were the biggest contributors. There's no doubt about it. I mean, you had about 18 after the 2005 storms, and you're not just talking about Katrina, you're also talking about Rita and Wilma. I mean, it was a huge storm season. The program was about $18 billion in debt, and then you had Sandy come along and it added a huge amount of debt. But I'll point out is that last year, when really the only storm that you could really think of as Hurricane Matthew, was the program. It was $3.6 billion. It was one of the largest loss years in the program's history, and so it did for years kind of dink and dunk, where it was a little bit in deficit, a little bit in surplus. But in reality, we recognize there are going to be these huge storm events. There are going to be these sort of these black swan events that are going to have huge costs, and that was only a matter of time before that would occur.
I want to hear from our viewers. Do you have national flood insurance? Are you part of this program? What's your experience been? Tell us about your part of the country. We split up our phone lines regionally in this segment. If you're in the Eastern or Central time zones, it's 202-748-8000. If you're in the Mountain or Pacific regions, 202-748-8001. Stephen Ellis is with Taxpayers for Common Sense. We were just talking about some of the recent big storms. Here's how much the National Flood Insurance Program has paid out from some of the biggest storms. You can see Hurricane Katrina there at the bottom from 2005, $16.3 billion paid out of this program, $8.5 billion paid after Hurricane Sandy. At the Louisiana Flooding in 2016, it was $2.4 billion. Getting your calls. Tina's up first in Holly Ridge, North Carolina. Tina, you're on with Steve Ellis. Go ahead.
Thank you. I live on the coast in North Carolina, and I'll tell you, the last bad storm hit more inland and did more damage than it did along the coast. But guess what? Our insurance didn't go down, and theirs didn't go up. So I'd like to hear this gentleman's interpretation of their assessments.
Thanks, Tina. So the Federal Flood Insurance Program, they create risk maps, and so they do these maps of various zones. If you're in the X zone, you're not as risky. If you're in the A zone, you're more. If you're in the V zone, you're along the coastal area. And so certainly I wouldn't say that a flooding event that doesn't occur where you live should change your risk profile, but clearly it does mean that these areas that did flood, that they are going to be at a higher risk, and it's something that FEMA should take into account. And the maps are a huge fight often between communities and FEMA, who administers the program, the Federal Emergency Management Agency, because it can determine whether you have to buy flood insurance or not, and also what the cost of your flood insurance is. And what Tina also raised, and I think is important, is that people both, and you mentioned Louisiana flooding in 2016. A lot of that was in Baton Rouge. That wasn't coastal. That wasn't. It was actually a huge rainfall event that occurred there. And what FEMA said was that if you had flood insurance, you got about $86,000 in a payment. If you didn't have flood insurance, you got about $9,000 in disaster assistance. And so your home was flooded, you still had a mortgage, you could maybe get a low interest Small Business Administration loan, but you're really in a bad spot if you don't actually have flood insurance and you get flooded.
Andy is in Hibbing, Minnesota. Good morning. You're on with Steve Ellis.
Good morning. My question is on the floodplain areas. How many times can a person get bailed out by this insurance? Do they ever say that's enough, that's too dangerous a place, we can't bail you out again?
Thanks for calling, Andy. And so they're moving in that direction to actually saying, okay, enough is enough. But there have been studies where houses have been flooded many, many times over and actually gotten payments that exceed the cost of the house. But in the house, in the House of Representatives proposal, they do have a provision where if you've basically been flooded and gotten payments in excess of 2 times the replacement value of the home, so it's like replacing the value twice over, then you're basically out of the program and you'd have to get private flood insurance. And so it's trying to move that direction. There's another policy that, like, basically in about 4 years time, if you build new construction, so new construction in the 100-year floodplain, in the special flood hazard area, then you would have to go out in the private marketplace to get flood insurance. It could not be through the federal flood insurance program.
John is in North Carolina, says, where in the Constitution does it say that the government should pay for flood insurance for beach houses? As this program is being reauthorized, is there an effort to not reauthorize it? Are there members of Congress saying this is it, this should be done?
No, I think I mean, the one thing that's kind of interesting about the flood insurance program, and you even recognize this by the way you did the caller distribution, is that it cuts across regional lines rather than partisan lines. And so if you're most likely to benefit, or your constituents are most likely to benefit, you're going to be more supportive of the program. And it's part of the reason why, you know, as an organization, a budget watchdog, we're always concerned about the federal government getting involved in the insurance industry, whether it's crop insurance or flood insurance or terrorism insurance, is that it's never a politically popular move to increase somebody's rates. And so there is an inherent incentive to provide these subsidies. So the caller is John is absolutely right, is that there is no provision in the Constitution, but we are where we are, and you have to kind of deal with that problem and how we are, and the fact that we have 5 million people who are in this program, and we'll have to deal with that as we go.
Taking your calls with Steve Ellis of Taxpayers for Common Sense. Those lines that you've referenced, 202-748-8000 if you're in the Eastern or Central time zones, 202-748-8001 if you're in the Mountain or Pacific time zones. Jim is in Pittsford, New York. Go ahead.
Good morning, Steve.
Good morning.
We have a town here, Batavia, that is surrounded by a creek, and these folks who lived there for 50 years, you know, went from $400, $500 a year to $3,000, and it never flooded. But here's the thing: they're forced to pay for insurance. They're not going to be able to. No one's ever going to buy their houses to start with. I wouldn't consider it a flood area. And if it does flood, the requirements are that it has to flood the threshold of the house, so you can fill your basement up to the top step and not be considered a flood. And on top of that, the neighbor's house has to have the same effect before you can even get the money for a flood. So these people are taking in the chin here, and, you know, it's not a coastal. There's nothing coastal or anything about this area. So, you know, these people are paying for something that you know, other people decided to live on the water, you know, in a volatile area, and I just don't think that's fair.
Well, I think that, you know, as Jim was talking about, I mean, these are all very local issues as far as, like, what is the actual geography, what is the actual elevation of the land, what is the likelihood of flooding, and just because you haven't flooded in decades doesn't mean you're not going to flood or you don't have that significant risk. You can just be happy that you haven't flooded so far. And, you know, certainly communities can challenge the maps. I mean, a community has to agree to the rate map from the flood insurance program, from FEMA, and so they can say, well, no, we think we're actually not at this risk profile and a certain elevation. And then also, you know, part of our argument for why getting the private flood insurance market in is, for instance, right now you can only get flood insurance up to $250,000 the value of the home.
Under the federal program.
Under the federal program, $100,000 for contents. You don't cover basements. You don't cover other structures, like a separate garage or something like that. All of that could be dealt with in the private flood insurance program, and that's where we think things should be moving.
Quickly on the maps, have those maps ever shrunk over time, or do they keep expanding?
Well, according to FEMA, and they've said this at different times in testimony, is that basically in any given year they map about the same amount of properties out of the program, out of the high-risk floodplain, and into the high-risk floodplain. So, I mean, it does show that it's dynamic, and you obviously have issues of sea level rise in some places. You know, you're not going to have that necessarily here in this town, but you do have somebody builds a shopping mall, or there's a parking lot, or there's another flood damage reduction structure, and that's going to change the flood profile of various communities, just essentially other development decisions.
Kimberly is in Philly. Good morning.
Hi, I have a question pretty much related to what you've just been talking about. And my question is, how often are those flood zone maps updated, and what determines whether properties are moved out of the flood zone? And the reason why I'm asking is because, similar to the other caller, I have two properties that are considered in the flood zone, and I've lived there for over 20 years and never experienced a flood.
Hi, Kimberly. Thanks for your call. You know, as I said before, just because you haven't flooded before doesn't mean you're not at risk of flooding and then may have future floods. There was a lot of Americans, I think, that found that out, particularly in last year from rain events. And then also, we would like to see FEMA update these maps even more frequently. The state of North Carolina basically took the mapping dollars from FEMA and actually flew a low aircraft plane, did LIDAR, which gives you very high resolution data to figure out the elevation of all these different properties in our riskiest counties, and did it for about $25 a property. We would like to see that done on like a 5-year cycle that could actually update that. But as far as the particular maps in Philadelphia, I'm not sure.
So FEMA does farm this out to individual states?
Well, in this case, the state of North Carolina said, thank you very much, we'll take care of this ourselves. And FEMA said, okay, we'll allow you to do that. And I think did a really good job of that, and then actually made all that information available online to people to see what their actual risk is. And that's also one of our concerns with this program, is that when you subsidize people's premiums, you're actually failing to do a fundamental job of a government, which is to protect their citizens. And that this is a key risk communication factor to know, okay, well, my premium is too expensive. You know, it's $3,000, as it was said in New York. Well, what can I do to reduce my rate by reducing my risk? What can I do to mitigate, or what can the community do to mitigate that risk, and then actually drive down the rate by driving down the risk?
Yvonne is in St. Paul, Minnesota. Good morning.
Good morning. You know, I was looking at the map, and I noticed, you know, these areas. I'm originally from Florida, and I bought my first house, and my dad kind of chided me into getting a flood policy, even though I'm in what's considered a preferred risk area. And it's not cheap. It's about $400 a year. But I read when I got a letter in the mail recently that 25% of claims actually come in from places in preferred risk areas. And, you know, that was kind of shocking to me. And as an attorney, I know insurance companies don't always clearly define what flood is or what water damage is. And I think that they do need to do a better job of kind of communicating the sort of risks and losses that they will cover in the event of a flood.
Yvonne, thanks for the call. Steve
Yeah,
Ellis.
absolutely. Thank you very much, Yvonne. And actually, I couldn't say it much better myself, you know, and the fact that, yes, a significant percentage, she said 25%, I've heard even higher figures, of flooding occurs outside of that special flood hazard area, that 100-year floodplain. And those are the people, like I said, that are only getting, in the case of Baton Rouge, about $9,000 worth of disaster assistance rather than the $86,000. And so I think that if she ever does flood, Yvonne will be happy that she has that flood insurance policy. And she also mentioned this whole question of the wind or rain, and there has been this fight famously, or maybe not so famously in my circle. Senator Lott actually sued his homeowners insurance company because they were saying, well, it was actually flood, which is going to have a lower amount that they would pay out, and also not be the insurance company paying out, but the taxpayer, rather than wind that caused the damage to his house after Katrina. And so, you know, one of the other things that we think is important as you move towards the private sector, you're going to remove some of that discussion of whether it was wind or rain. You're actually just going to be one insurer, and it's going to be just a rider on your other policy.
Out of curiosity, what happened with the Lott case?
You know, there was some agreement, some final settlement was with State Farm over how that coverage would be.
Back to the phones. Bob is in Tyler, Texas. Good morning. You're on with Steve Ellis.
Yes, this is in response to the tweet. I was actually getting ready to call before I saw it. And your guest, Stephen Ellis, says we have 5 million insured, and we just have to deal with it. Okay, now America is in chaos in multiple fronts. Health care, the budget, and this flood insurance is another example. And the way we deal with it is we hold our elected representatives to their oaths of office to protect and defend the Constitution. And there's nowhere in the Constitution where flood insurance, health care is delegated to the feds. So that's how we deal with it. We vote for people that are going to make a change and they're going to follow their constitutional oath. Thank you very much.
Thank you, Bob. So, I'm just trying to deal with the reality of the situation, the fact that we have, more than $1 trillion worth of coverage out there. And so we're going to have to deal with that in a responsible manner. We certainly would like to see the movement towards is all moving to the private sector, or much of it moving to the private sector, and that's going to be an evolutionary process. I'm certainly completely aware. I mean, I work for a budget watchdog organization.
I was going to say, this might be a good time to explain what Taxpayers for Common Sense is.
We're a national nonpartisan budget watchdog. We work on a wide range of issues dealing with spending and taxes. We're certainly concerned that we're about to top $20 trillion in federal debt and try to deal with those issues. But we're also trying to come up with responsible solutions that can actually get through Congress. And it's not lost on us that, particularly on the flood insurance program, and then we work on national security spending and agriculture entitlements, taxes. But in 2012, there was a fairly aggressive reform bill that was adopted called Bigger Waters. The problem was
this was the last time it was reauthorized.
Correct, exactly. That's that started that 5-year clock that expires September 30th. It wasn't even 2 years later that Congress went back by the bill. Bigger Waters passed with big bipartisan majorities, and repealing parts of Bigger Waters passed with big bipartisan majorities in 2014. And so essentially what I think that people like Chairman Hensarling, who's the chairman of the Financial Services Committee, who's dealing with this, recognize we're going to have to do this in an evolutionary process of moving this off of the books, because we've now done for basically for 40 years, almost 50 years, we had this program.
The parts that were repealed in 2014, were those parts that were moving this off the books, as you say?
Well, moving it towards risk-based rates. Essentially we were trying to move it towards people paying the full risk-based premium. Now, we're still seeing rate increases because it has, you can change the rate by a certain percentage every single year. But for instance, basically it made it so that the movement to full risk-based rates wouldn't go nearly as quickly for primary homes. It would still do that for second homes, for business properties, and for severe repetitive loss properties. And also, it wasn't going to change your premium basically upon home sale. So the new homeowner isn't going to be paying full freight. He's going to be still, or she's going to still be paying that subsidized premium.
Time for a couple more calls. If you're in the Eastern or Central time zone, 202-748-8000. Mountain and Pacific time zones, 202-748-8001. Cheryl's been waiting in Clear Lake City, Texas. Good morning.
Good morning. The southeast side of Houston is where the Johnson Space Center and all the chemical plants and oil refineries are located. And our homeowners insurance, due to the risk of hurricanes, has already gotten tremendously expensive. And we would be completely unable to sell our houses if the flood insurance keeps going up. Part of the risk around this area, of course, Houston is notorious for flooding anyway, because basically Houston is built on bayous and swamps, so it doesn't drain very well, and it's grown so much that they just poured concrete all over everything, so there's not a whole lot of land left anymore to absorb the water. And then on the southeast side of Houston, where the Space Center and all the chemical plants and refineries are located, we're not too far from the Gulf Coast. And a big worry for my husband and I is that if the flood insurance program is canceled or goes up, we won't be able to sell our home. And most people in this area, their home is their biggest asset that they're, looking to be able to sell when they retire. It's a tremendous worry. In 2012, when they talked about ending a lot of the subsidies for the flood insurance program. There was one neighborhood right behind the Johnson Space Center where they looked at what it would do to the premiums, and it would have pushed the flood insurance premiums up to between $3,000 and $6,000 or $7,000 a year, depending on how close to Clear Lake the people lived. And the mayor of this little community, was horrified because there's a bunch of Space Center retirees over in that area. So it's a big worry to my husband and I. We're native Houstonians, and we're living on this side of town because he's a chemical engineer and works at one of the chemical plants. I think there's a difference between somebody's home that's their primary residence that they've lived in for years and somebody who has a second home, on the beach somewhere. That's
Cheryl, thanks for sharing that and the story of Clear Lake City. Steve Ellis.
Yeah, no, Cheryl brings up an important point, and certainly Congress did make that distinction between primary homes and second homes when they repealed parts of the Biggert Waters bill in 2014. I think the thing that to keep in mind is, and a lot of people talk about the premiums, is that subsidizing the premium and reducing the cost doesn't reduce that person's risk. And clearly, if you higher your premium, the higher the level of risk that you have. And so it is an incentive for communities and for individuals to mitigate that risk. And so we think it's critically important to actually have that. And then if there is people that need assistance, means-tested assistance, that could be provided. It should be done outside the rate structure so that people actually see the level of risk, but then have some sort of means-tested assistance for some people.
To Malden, Massachusetts, Rosemary, good morning.
Morning. I'm just calling just to give this young man some information. We have ocean water. I'm right on the ocean, 5 miles I'm near Boston. Ocean water going into freshwater lakes that surround. We flooded 20 communities because the engineers weren't there to close the diesel locks, okay? And the bottom line is one of the things you have to do is get flood insurance if you go to FEMA. I am not even in a floodplain. They closed the storm drain. 25 communities flooded, okay? And they have never flooded since then. Nobody was on duty. They went by the 11 o'clock weather report. Okay, they were 40 miles away. I called the dam, and they said nobody was there. And the only cities that didn't flood, Burlington, Winchester, Malden, Medford, the only cities that didn't flood, which was Revere, which is right on the ocean and floods every storm. But they were working.
Rosemary, thanks for sharing the story. Was there anything you wanted to pick up on from that?
Well, just that I appreciate that she called me a young man. I haven't been called that in a while, so that was nice.
Mary is in Ashland, Kentucky. Good morning.
Hi, how are you?
Doing well.
And thank you for having this program. I get up just to watch you. I wanted to comment about, I want to get this out to other people. If you want to get your government to work for you, let your call your congressman and communicate with them, because I have been communicating with mine, and I've actually seen some things happen or see them say things that I actually wrote about. But the last thing I've been writing about is about is flood control and things like that, because I thought it was great that Trump pulled out of the Paris Accords, because we need to take that money and spend it on infrastructure here. We need to do a better job with the Corps of Engineers cleaning out streams and gutters and drainage pipes to make sure that these things don't back up. And just better infrastructure and better planning and better engineering when they build places. And I did like what that woman said about the second homes. It's just ridiculous. They want to build that close to the ocean front and not expect to be flooded. But that's all I have to say.
Mary, thanks for bringing that up. Are any of these issues something that Safer, Smarter is working on, the coalition that you're working with?
Well, certainly Smarter, Safer is concerned about some of these issues about disaster funding as well. Like what I like to say is that every disaster is an opportunity. It's a tragic opportunity, but an opportunity nonetheless to pre-spawn to the next future disaster and to make communities and individuals less vulnerable. And then also, Mary talked about the Corps of Engineers and about some of the infrastructure. And, from our concern, from Taxpayers for Common Sense's point of view, is that, we want to make sure this is done in a responsible manner, and that if there is going to be an infrastructure investment, we should be prioritizing that funding. Right now, most of our infrastructure investments don't have prioritization systems, including the Corps of Engineers, who build flood damage reduction and storm damage reduction projects. We should go for repairing existing infrastructure first, and then we should be looking at taking some of the infrastructure off the federal books. So we should be looking at, are there dams that are no longer functioning or waterways that we should not be maintaining as a federal resource? And so I think we need to be very clear-eyed about how we make those investments rather than just dumping a lot of cash into infrastructure willy-nilly.
We'll end our weekly Your Money segment there. If you want to check out Taxpayers for Common Sense, it's taxpayer.net. Steve Ellis is the Vice President of Taxpayers for Common Sense. Thanks so much.
Thank you, John. And thanks for this program.
Up next, it's Open Phones on the Washington Journal. We're going to open up our lines to hear about the public policy issues that you want to talk about. Lines for Republicans, Democrats, and Independents on your screen. You can start calling in now, and we'll be right back.